What's up guys, today we're going to go over the best way for the average Joe to get rich in the stock market. We're going to go through some of the most common mistakes that most new investors make, and then I'm going to show you how to not make those mistakes, because I'm not going to lie, I made those mistakes, but right now I have a $2 million investment portfolio. I started with nothing 5 years ago, so all the lessons that you're going to learn along in this video is really going to help you out, so here we go. So I'm just going to show you guys the power of investing the correct way. So my trading account right now is $294,000. I made $8,900 today, and my 2-year return is $498,000. I literally didn't even look at my portfolio today, and after the market closed, I looked at it and I made $8,900 for doing nothing. So just for this video, I typed up the 10 most common reasons why people lose money in the stock market. This applies to experts, this applies to beginners, but every single one of you guys that are watching this video right now, I don't care if you're an expert or a beginner, I can pretty much guarantee you that you make at least one of these mistakes on here, and pretty much every single one of these mistakes could be a fatal flaw to your portfolio. You could lose everything if you make these mistakes. A couple of them at the end, like number 9 and number 10, they're crucial not to do. So let's start out on number 1. So number 1 on the list is when you make emotion-driven decisions. So this is letting fear, greed, or panic influence when you buy or sell. This often leads to one of the biggest problems where you buy high and you sell low. So let's just think about this. When stocks are going up, everyone's happy, 95% of investors are happy, they're FOMOing in, they say the market's gonna go up, it's never gonna go down, it's going straight up. Your sentiment in your brain, you are happy. You're happy to invest in the market. Smart investors, they don't wanna invest when the market is going up because they know that it's becoming more expensive as it goes up in price. So smart investors sell when the market is high. Now on the flip side, when the market is going down, the typical investor, they like to sell when the market goes down because they're getting scared. They're like, oh, well, what if it falls from $100 to 90? What if it goes from 90 to 80? The problem when investors do that is you're gonna be selling low, and you're gonna be selling at the worst possible time because the market's actually on sale at that time. So why would you wanna sell when things are cheap? If anything, you should wanna buy when things are cheap. You wanna buy when things are on sale. Just pretend you're going to a car dealership and you're gonna buy a car today. If it's 50 grand today and it's 40 grand tomorrow, you're happy to go buy it on sale for 40K tomorrow. So why are you not okay to buy stocks that are on sale today? So number 2 is having no plan. So if you have no plan, no investment strategy, no goal of what you're trying to achieve, you don't know what you're working towards. You're just shooting darts at a wall and you're hoping something sticks. You're hoping you buy Nvidia calls and you're hoping they 10x overnight, but chances are you're gonna lose all your money doing that, so you have to have a plan. Number 3, and the one that most people screw up the most, is timing the market. So let's do a quick little example here on timing the market. So let's say you bought shares of Triple Q somewhere in this range over here. You say, okay, I'm gonna sell at the top and I'm gonna buy at the bottom. You have to time the market twice. So are you good enough to know that this was the top right here, and are you good enough to know that the bottom was right here? I know looking back it might seem obvious that this was the top and this was the bottom, but when you're in a mix of doing this in real time, nobody on earth knows how to time the market even one time, let alone twice. There's always going to be people out there saying, oh, this is the person that called the top in 2008, this guy called the top in 1999. It's all baloney, because people like that, they write articles every single month, and the one time that they are right, the single time that they are right, probably out of 100 times, that article will get published everywhere. It'll get published on a day that the markets are down, and it's gonna make it look like that guy's famous, and then all of you guys are gonna go take your money and go put it in that ETF because he made money this one time. But a broken clock is right twice a day, and typically speaking, trying to time the market does not work out because nobody knows where the bottom of the market's gonna be, nobody knows where the top's gonna be. What if you thought this was a top right here, 459? It went down a little bit, okay, you sold. So you sold right here because you freaked out, but then look at this big move that you just missed right here. And then look at just zooming out. If you would have just looked at any of these little dips right here, nobody on earth knows where the top and the bottom of the market's gonna be. So don't act like that you do. Number 4 is a big one, and number 4 really applies to beginners because beginners get overconfident when they go make their Robinhood account, they put some money in it, they buy a call option, and they make money. They're like, I'm smart, I made a good decision because the market went up, so I'm right, and I'm always gonna be right going forward, so tomorrow I'm gonna buy double the amount of call options, and then you get wiped out. The best thing for new investors is it's better for you guys to lose money starting out, not make money, because if you make money as a beginner, maybe you make $1,000 on one trade, then you go to your savings account, you go put $20,000 into Robinhood, you bet it all on call options saying, oh, well, if this does this, I'm gonna make $100,000, but the next day the market goes down, you could lose $20,000 right there. So overconfidence is a big thing to avoid. So So number 5 is a lack of diversification. So I understand that most millionaires and most billionaires, they do not diversify a lot. Warren Buffett always says diversification is for beginners. But here's the deal, 99.9% of people out there, they will do best if they diversify their portfolios. If you have all your money in Apple and all your money in Amazon, you have 2 companies. So this chart right here is key to look at, and it's key for you to understand. So the S&P 500 is 500 of the largest companies in America. So only 52 out of 500 companies since 1955 were in the index in 1955, and they're in the index right now. So literally 90% of the companies in the S&P 500 50 years from now are probably not going to be in the index. What does that mean? If they're not going to be in the index, that probably means that the companies went bankrupt, they got bought out, or they're just companies that just ended up failing, like BlackBerry's, Motorola's, things like that. So nobody really knows what these companies are going to do 20 years going forward. So if you have all your money in Apple and Amazon and you think they're great, they might be great right now, but 20 years down the road, we don't know. Maybe we won't even be using cell phones 20 years down the road from now. So number 6 is chasing trends. So chasing trends kind of follows the first lesson we went over with emotional investing. So this is when you follow the hot stock, the stock that everyone's talking about, the stock that's all over the news headlines, the stock that everyone is saying they're buying into. Usually when it's mainstream like that, that is when there's peak euphoria priced into the stock price, and it can't really go much higher at that point. So really the only way to go is down. But beginner investors will YOLO into the market, they'll buy call options into that stock, they'll go into a Robinhood account, max it out, they'll come out of their savings account and do it, and they get wiped out, they get smoked, and then you turn around and say, I hate the stock market, I'm never doing this again. So don't get caught up chasing trends just because everyone's talking about it. So number 7 is a big dog right here. So you don't want to ignore the fundamentals. So what do fundamentals mean? Fundamentals is how much money does a company make, what's their revenue, what is their guidance going forward, are they expected to make more money in the future, are they expected to make less money in the future, do they have a ton of cash in their account, do they have more cash than what their liabilities are, can they pay their bills on time, do they have to issue new bonds in order to pay these bills? All of this stuff matters. Just because something is going up in price, it doesn't mean that the company is worth that price. Just look at 1999. 90% of the tech companies in 1999, they went bankrupt. But there was so much money piling into the stocks because they just had a .com at the end of the name. So you really got to understand, is the company making money? So failure to adapt is another big one. So there's always times where you say, I'm going to buy into something, I'm going to buy this stock because of reason X. But if reason X is no longer a factor, let's say that you're going to buy into Tesla because you believe in the robotaxi network and you believe in the Optimus robot. But what if Tesla comes out and says, we're not going to do robots no more, we're not going to do robotaxis anymore? The total valuation of Tesla will change drastically. So you have to be able to adapt in situations like that. You need to be able to adapt quickly. So excessive trading is another big one. Most people will do great if they buy into quality companies, quality ETFs, and they hold them for the long run. Because remember, the goal of every company, increase revenue, cut expenses, boost earnings per share. If you look at that on a month-to-month time frame or even 1 year versus the next year, it's going to be bumpy. But if you hold Apple stock, say for 10 years, look at the earnings growth and revenue growth of Apple in the last 10 years. It's drastic. So the longer that you hold something for, the better. And also factor in short-term versus long-term capital gains. Short-term capital gains are usually taxed much higher than long-term capital gains, and a cutoff is 1 year holding period on that. And number 10 is the big dog, leverage and margin. So leverage and margin can be used to magnify your returns, both good and bad. So let's say you have $10,000 in your account and you take $10,000 of margin. You go into Robinhood, you buy $20,000 worth of whatever company you want to buy. If that company goes up, you'll do great, you'll make a bunch of money. But if that company goes down, you will lose your original $10,000 potentially, and you will owe the margin loan to Robinhood, so you'll end up negative at the end of the day. So margin, you only want to do that when you really know what you're doing and you have extremely high conviction in your trades. So now the top 5 ways that the average Joe can get rich in the stock market. So it's going to be boring, and you probably heard of this before, but just stay with me for these top 5 reasons because you have to understand all of them because it's going to change your mind about a couple things. So number 1, you need a dollar cost average into the S&P 500 or companies that you're okay to hold for the long run. So dollar cost averaging is one of the most powerful strategies to consistently invest a fixed amount of money at regular intervals regardless of what the market is doing. This strategy, called dollar cost averaging, reduces the impact of market volatility and ensures that you're buying more shares when prices are low and fewer shares when they're high, lowering your cost basis over time. So that is important. So you don't ever have to worry about if you're paying too much for something versus you're getting a discount, because over time you're going to get an average price. An average price is okay though. So number 2 is you want to invest in the S&P 500 for the long run. So the S&P 500 tracks the 500 largest companies in America. This index in the last 50 years has gone up 10% per year on average. Every year is not going to be an even Steven 10%. It might go down 20%, then up 40%. It's going to bounce all around. But if you do the total return divided by 50 years, it comes out to roughly 10% per year. So it's also important that you invest into an S&P 500 index fund that is low cost, such as VOO. There's an expense ratio on every ETF, and it's very, very important that that is low, because if it's not low, you will get smoked on fees. Number 3, you want to ignore the market news. The media often sensationalizes short-term market fluctuations, and this causes new investors to make rash decisions. So successful investors and experienced investors, they know that the market moves and booms and busts. They know that that's normal, but they like to buy when other people are being fearful, and they like to sell when other people are being greedy. So sell high, buy low, that's the key. Now you also need to think, are you going to bet on America or not? Do you think America is going to be bigger, better, and stronger in the future from right now? My answer is yes. So by investing in the S&P 500, you are making that bet that America will be better in the future. So the last one is you need to have a long-term time horizon. It's one of the biggest advantages because the longer that you hold your investment, the longer that your money has to grow and compound. Just think about it. If you have $100 in your account right now and you make 10%, you make 10 bucks. But if you have $1 million in your account and you make 10%, you make 100 grand. So it's important to build your account up as fast as you possibly can so that you can take advantage of compounding. So this was a little bit different style of video than I normally do, but I wanted to get the information out to you guys in a really good way. So also, if you want to learn how I went from 0 to $2 million in 5 years, I've developed a course called the Stocks and Psychology of Money Blueprint. This course will teach you exactly how I did it, when to enter trades, when to exit trades. Everything that you need to know about the stock market and stock options is going to be in this course. So there's going to be a link in this video description. Check that out. And if you made it this far, make sure you like and subscribe, turn the notification bell on, because I make videos roughly every other day about the stock market, investing, and money. So I'll see you guys later.